Thank you so much. Thank you, everyone. My name is Emmanuel Inyada, and I'll be sharing on venture financing, and I'll be looking at considerations that startups and SMEs should basically be aware of if they're looking at raising financing for their businesses. I'm not with the slides with slides basically, but I can share later on. But I'll be speaking from my notes here. So what is venture financing? It is also referred to as venture capital, and it basically refers to um, investors putting money in a business for equity in that sense. So if you are a small business owner or a startup and you need to raise additional finance to continue to grow, not debt now, but let's say you want to give them a stake in your company, then that is venture capital. So they get equity in your business for the money they are putting in. As a startup, what should you look out for? Do you need to raise money? Well, there's something known as bootstrapping, basically. So you can decide early on that I don't want to raise money through investors. I'm going to fund it by myself, through family, and grow along the line. And if you feel like you can't do it all alone, in that sense, you have to begin to look out to raise finance from investors, and investors usually want money, usually want equity in return for their investment. And before they do that, they must have perceived that the startup is, or the SME is poised for growth and it has a viable business model. Before I continue, let's look at what is the difference between a startup and an SME, basically. Toib was speaking earlier about registering a business and was talking about the different form of corporate organizations, talking about business names, talking about limited liability companies and all. For investors to want to invest and bring in equity, they have to be able to get shares in the company. And that means that business, that company must first be registered with the Corporate Affairs Commission, and preferably as a limited liability company, because you cannot get shares in any venture if it is not a limited liability company, basically. But for startups and SMEs, basically, if you want to raise venture finance or you want to raise venture capital, you have to register as a private limited liability company. So I was going to talk about the difference between startup and SMEs. Basically, they are very similar, but one difference I would highlight is the fact that startups are looking at fast growth. They are not looking at making money early on. They are also not looking at, let's say, remaining with the business long term. But SMEs are structured differently. They are looking at making money from day one. Their growth will be quite slow in that sense, and they want to remain with their business. It's basically a baby, and they don't want to give up control easily. And they are usually within a particular geographical region. They are not looking at global expansion or all those, or listing on a public stock exchange. But startups are eventually they have these goals of, okay, we are going to disrupt the market, we are going to innovate all over the world, we are going to expand, and at the end of the day, list on the public stock exchange if they decide to do that. So as I said earlier, the structure for startups and SMEs, for it to be able to attract venture capital, it has to be registered as a private limited liability company. It also has to have a proven track record in the sense of the business it has a viable business model. It has good products. Basically, it's meeting a need that in the market. There is a solution being provided for users in that sense. So if you look at Nigeria today, the Nigeria venture capital market, we realize that we've been hearing of, let's say this company raises so money from investors. This company raises maybe $2 million from so investor. Those are essentially startups, and those kind of transactions are VC transactions. So for a startup to be able to attract investment, I said earlier, they have to be structured properly. They have to be rated a limited liability company. And if you're looking for that, you can decide that you want to, let's say, use a old co structure to be able to attract foreign investors so that they can basically be rest assured that they won't be affected by all the risks in Nigeria. also you also want to ensure that since you are creating a product, you are also creating intellectual property. And as Rita highlighted earlier, to get registration, you have to register these rights, because it affects the valuation of the company in the long run, with regards to, okay, how much the investors will decide to invest in the company and how much stake they would want to get in the company at the end of the day. So there are different type of financing rounds. Let's say if you're a startup, there are different rounds of startup finance. There are different rounds of investment, basically from early stage down to let's say Series D, or whichever one the startup would do, up until exit. So looking at seed round or pre-seed now, start on pre-seed round. Basically, that's the money you put into the business yourself. Your family and friends supported you with, take it off the ground to just get the ideas in motion. So that's what the money you get, that are very small, that there are trickles in that, small sums. Then we also have the seed round, is like the first official equity round in any financing process. So basically, here you have investors coming in, you also have family and friends, but now they are saying that we want equity in your company, we want shares in your company for the money putting in. And this basically helps the business, let's say, carry out market research, let's carry out some registrations that they need to get, licenses that they need to get if needed, and employ additional staff, but it's basically still helping them to build that product or build the company, basically. And after these two rounds are referred to as early stage investments, and they can last for as long as possible, or they can keep raising seed finance until they feel like, okay, they've achieved sufficient growth to want to, let's say, now move on to the next round of investment, which is Series A. Here we have more sophisticated investors coming in, investors like VC funds, venture capital funds. We also have angel investors also looking at, okay, jumping in. Of course, both VCs and angels can also come in during the seed phase, because they are already getting equity in the company. But also Series A round is basically to help the startup. Startup usually raise, and it's the amount in Series A, they usually raise an amount that is larger than that in the seed round. And of course, the valuation of the startup would have increased at this stage. So from Series A, they raise additional finance to let's say continue to build the product, continue to expand, hire additional staff, improve market reach. Maybe like they would decide, okay, let's see, invest more in advertising of the product and the service, the product or service in that sense. And that's what Series A basically is for. And for Series B, there's also, after Series A, and you feel like, okay, you still need to expand more, you still need to do more, depending on the goal and the startup, they can have Series B finance, where they essentially expand market reach. That's one. New investors can come in at this stage. Existing investors can decide, okay, we want to invest more. In that sense, they expand market reach. They begin to build viable infrastructure. They can decide, okay, at this stage, we want to maybe build new products, maybe new offerings in that sense. It's similar to Series A, but yeah, the startup is already existing and growing, and it is investors are a little more confident in the growth potential of that startup. They're already off the ground, they're already making money in some form, basically. And then they can decide to go maybe Series C also. Maybe they want to acquire other startups because of, let's say, maybe a particular product that they find attractive, or maybe to just deal with competition in the market. They can raise a Series C to do all those. After the Series C, you can go on and on and on and on and on. As far as there is need money, we can go to Series D, Series E, as long as they want. After all those, there's also, let's say the startup decide, remember I said earlier, that startups actually have an end goal in mind, either to maybe exit by liquidation, that means maybe selling to other startups, or listing on a public exchange, or in that sense. So they can decide, okay, we want to stop here. Let's founders now, and we want to exit. The investors can say, okay, let's sell to another startup at a price, basically higher and multiples that brings in multiple value than the amount the investors put in the first place. And yeah, that's it basically. So I want to talk about looking at all these rounds of investments, what should startups really be looking at? What should they be doing to be able to make investments when the investors want to put in this money in good faith and to stay with them and stick with them in the long run? One thing is that they must, one, have a viable product. They must have a proven business model. They must have a great team. They must also comply with the provisions of the law, especially in their own country and maybe wherever else they are incorporated, with regards to registration, licenses, and getting all relevant regulatory approval for the startup to run. They have to do all those. And because investors usually look out for these things at the due diligence and diligence stage prior to investment. So when you are looking at, let's say, raising finance, you have to make sure that you have all your documents in order, all the approvals in order at the stage of due diligence, because at due diligence, we have both legal and financial due diligence. You have to make sure that your books are in order. You have to make sure that your IP rights are registered. You have to make sure that your employees now, not that the product they are creating, which basically is the key to the running of your startup, is basically that of the employee. So you have to make sure that the employment contracts contains an assignment of intellectual property clause that makes the employees and whatever they create for the company, the property of the company, to avoid, let's say, the situation Rita referred to in South Africa, that particular case, a situation like that where they will be unable to, the company will be unable to exploit the product they paid the employee to create for them during the course of their employment. So you have to make sure that you have that kind of clause in the employment contract. You also have to make sure that with regards to partners and other people you've spoken with, you have NDAs and agreement, confidential agreements with them that would stop them from disclosing. Also, startups basically face a lot of, this is general now, a lot of pushbacks from investors generally who say that startups basically are bugging them with non-disclosure agreements, especially with regards to maybe they want to raise from them and like, okay, you're telling, okay, I want to share my idea with you, and you're giving them NDAs. Well, I feel this should be handled with a little tact in that sense. If you know someone can invest in your startup, because you know most these investors basically listen to lots of pitches and they listen to a lot of similar ideas. Well, this is what I'm going to say. Well, try to present the idea to them, maybe your business plan or pitch deck, whatever, and try to make them understand the confidentiality of this information. If possible, send the NDA, the non-disclosure agreement, or to them with tact that, okay, you have to sign this NDA so that you won't disclose. Because they could say, okay, see, let's say you have a fintech idea. There are several fintechs, basically. So how do you expect me to sign an NDA that I won't maybe disclose, whereas other people have the same idea you have? Just try to make them get that NDA in place. If you are discussing with mentors, if you are discussing with, let's say, people you feel you trust, try to make them understand that there are confidentiality obligations with regards to you sharing that idea or product with them. But at the stage of financing and all, make sure your investors sign a confidentiality and non-disclosure agreement. Also, you need to get the services of a lawyer to examine the term sheets that are going to prepare, because startups at the end of the day come out like they've been ripped off. If you don't want to give so much control in your company, you have to make sure that you are basically working with a lawyer who would examine the clauses in the term sheet to ensure that you are not ceding a majority stake in your company to an investor for a small sum. Looking at the potential of a startup, you also want to make sure that you retain control, maybe with regards to voting rights and all those things. You have to make sure you do all those. There are several documentation, basically, with regards to raising funding. VCs have a lot of templates that they present to startups. They have, let's say, convertible notes. Maybe you don't want them to be equity to convert immediately. In that sense, you have to have that consideration in mind. You don't also want to make sure that because you are going through several rounds of investment, that even though your shares would dilute, it happens in such a way that you don't lose out eventually. So maybe they're looking at, maybe investors actually want to have anti-dilution clauses in their agreements, in the term sheet and in the agreements, the definitive agreement they sign at the end of the day. So as a startup, if investors have this thing basically and they're protecting themselves, you also have to find a way to protect yourself in the long run. That's why you need a lawyer to look at these documents they present to you when you're about to raise finance, and examine the clauses, and advise on a proper step to take with regards to that particular agreement they've presented. So I think I've run through most of what I have in my head. I didn't really look at my notes, but yeah. So so basically, I hope this information helps. It's sufficient. But again, you need to don't Google search. Every when it comes to startup finance, when they are raising investment, don't think you can Google search your way through the clauses and all those things. You can do that for general information, but you need to get the services of a specialized lawyer to look at these clauses and examine their implication, looking at your stake in the company, basically.
Thank you so much, Emmanuel, for that expository view of venture financing and consideration for startups and SMEs. I'm sure the audience have taken notes of some of the number of the things that you've mentioned.